Did you know that having a proactive tax strategy can save you thousands of dollars every year? Many entrepreneurs miss out on these savings simply by waiting until tax season to think about their taxes. Hi, I'm Coach Tasha, and if this is your first time seeing me, hello, it's nice to see you. And to my subscribers, thanks for returning. Now, when it comes to taxes, too many entrepreneurs wait until the end of the year and miss out on huge opportunities to save money. So let's talk about why waiting until the end of the year, right, to think about taxes is just really going to cost you too much, okay? And I'm not just talking about financially, I'm also talking about in terms of stress and missed opportunities. Now, when entrepreneurs don't plan for taxes throughout the year, it often leads to a few costly mistakes. First, there's the risk of missing deductions. If you're not keeping up with your expenses, chances are you'll lose track of small but valuable write offs. For example, I don't know about you, but like these subscriptions be adding up, okay? Everybody got a subscription for us. You know, we pay these subscriptions every month. And so, off the top of my head, I'm thinking of something like my Amazon Prime, also my YouTube Premium subscription, my iCloud storage, and many others. So yeah, like for Amazon Prime, you can actually write off a percentage of that. If you use Amazon to like order supplies and equipment for your business and other items for your business. Okay. So also for YouTube, like I use YouTube for research. So I write off my YouTube Premium. Okay. And also, let's say, for instance, if your place of business, you have like, your clients or customers waiting, maybe you have a salon or a barbershop or any of those types of things or whatever, and you play music at your business, you can write off your music, like your Apple Music subscription, okay? And or at least a portion of it because maybe you also use your music subscription for personal use. Okay, but there's just like so many. I'm sure you get the point I'm trying to make, right? Every missed deduction means more taxable income, which ultimately means a higher tax liability. And this is the key term that I try to educate everyone to understand: tax liability. Okay, tax liability is the total amount of tax you owe to the government and your state, if applicable, based on your income, your expenses, and your applicable tax rates. Now, I'm actually going to include a link to a previous video I did explaining how tax rates work. But yes, essentially, your tax liability is your financial obligation to the IRS and state, which is calculated annually or quarterly, depending on how your business is structured. All right. Your tax liability can honestly feel like a surprise tax bill if you haven't set aside money for taxes all year. So you're probably gonna get hit with a larger amount owed, right, than you expected. Now, I've seen entrepreneurs who didn't plan ahead get a bill at tax time that really wound up straining their cash flow just because they hadn't allocated money each quarter. And you really don't have to wait each quarter. A good practice that works for me is that each time I receive a payment from one of my clients, I set aside a percentage of that for taxes. Now, you have to figure out a method that works best for you, maybe putting aside your tax money daily or weekly. But I put that into a business savings account so that when it's time to pay my taxes, at the end of the quarter, I don't feel so overwhelmed. Okay. Plus, since it's a savings account, it's actually, earning a little interest while it's sitting there. Okay. When we feel overwhelmed, it adds stress, right? And honestly, tax season is already busy enough. And trying to organize a whole year's worth of financials all at once, like that's honestly just a headache waiting to happen. Okay. When everything is disorganized, you're more likely to make mistakes or overlook critical details, which can lead to penalties or sometimes even an audit. So instead of waiting until the end of the year, taking a proactive approach to tax planning can really save you money. It can reduce your stress and it can help keep your business on track financially. In fact, that's exactly why I created my ebook called Tax Essentials for Entrepreneurs is to help entrepreneurs like you avoid these costly mistakes and feel more confident managing taxes. And the link is going to be in my description box as well as in the pinned comment below. Okay. Now, one of the biggest benefits of having a proactive tax strategy is maximizing your deductions throughout the year. Okay. Many entrepreneurs only think about deductions when like it's time for tax time, right? But by then you might have already missed out on opportunities. It's going to be too late to save. Okay. Let's say, for example, you need to maybe like buy a laptop or whatever for your business. If you wait until the end of the year, you might overlook that expense, or you might miss the chance to even buy it before the year ends. Sometimes making certain necessary purchases can honestly benefit you most for tax purposes. And when you plan ahead, you can take time for your purchases to purchase strategically, okay, to maximize your deductions. And it's not just big purchases, right? Small everyday expenses add up too, like what I was mentioning earlier. So when you're proactive, you're consistently recording these expenses so nothing gets lost or forgotten. Now, which tax deductions do you find most confusing? Make sure you comment below, okay? And I might cover it in a future video. But yes, keeping up with expenses month by month ensures that you're not leaving money on the table, okay? And I actually like to stay on top of mine more frequently throughout the month. But again, you have to set up a system that works best for you, okay? Now let's talk about estimated taxes. I recommend calculating your estimated taxes like early in the year and making adjustments as your income fluctuates because, you know, business owners, our income fluctuates, right? One main reason that it's a smart move to calculate your estimated taxes at the beginning of the year is so you'll have an idea of how much to set aside as the year plays out, okay? As your income fluctuates, you can make adjustments, you know, to these estimates to stay on track. And it will really help you avoid a big surprise at tax time and minimize any penalties for like underpayment. Now, a safe rule of thumb, I would say, is kind of like to allocate around 25 to 30% of your income for taxes. I know it sucks, but you know, that's just rough. If you want to put a little lower, it's up to you, but this can help cover your federal, state, and self-employment taxes. Self-employment taxes, as you should know by now. If not, it's your Social Security and Medicare taxes. But it gives you peace of mind as your income comes in and ensuring that you're prepared when your quarterly tax payments are due. Now, if at the end you paid a bit too much, then you'll be owed a refund. And if you didn't pay enough, hopefully the balance, you know, it will be within reason and it won't feel like nothing too crazy, okay? So I don't want to keep you all too long. That's all I have for y'all today. But I do thank you for watching. Please be sure to like this video so YouTube will push it out to more people who need this kind of help. And be sure to subscribe so you don't miss my next video. Bye for now, and I will see you at the corner of success.